In this presentation, we're going to create another invoice from a purchase order. So we did the same process last time. We're going to do the same process here. We'll do it a little bit faster. The idea being that we have someone that made a custom order for us. We went to the vendor with a purchase order. We made the purchase order. We then received the custom order, in our case, a guitar. We took that guitar now and we need to create an invoice from it, which we can populate from the purchase order. In essence, connecting the purchase order or creating the invoice from a purchase order. Let's zoom into it with Xero. Here we are in our Get Great Guitars dashboard. We're going to be opening up the trial balance first. So we're going to go to the accounting dropdown, and I'm going to go to the trial balance right in the saved reports, assuming that you have saved the trial balance in there, because I've kind of recommended to do that a couple times. And if you haven't, you know where the trial balance is because we've been there last time. So I'm going to then go back up top. I'm going to be right-clicking on the tab up top, duplicating that tab up top. So we're going to have the trial balance on the right. We're going to enter the data on the left. Let's go to our flowchart, back to the story. Quick recap of the story. Someone comes in, custom product. They want a custom product from up in our music shop store. And we said, okay, it's a custom guitar, so we're going to have a purchase order. We're going to send that to the vendor. The purchase order is just going to be information. It's not recording anything. We don't have any invoice. We don't have any payment at that time. Then we imagine the guitar coming and it has a bill attached to it. So we have the guitar and the bill now. We can then have two things happening. One, we need to record it on the vendor cycle, and we want to take that information and now record it on the customer cycle, considering the fact that we ordered that purchase order custom for a particular customer. So on the vendor side of things, we're then going to enter the bill, which will increase the inventory on stock, and the other side then go into the payable that we owe. On the customer side of things, we want to invoice the customer. So now we're going to be all excited and we're going to call our customer, say, hey, your guitar's here, come on in, pick it up, or we'll send it out to you, whatever we agreed on. And we're going to populate the invoice for that, and we're going to populate that invoice from the purchase order. So therefore, the purchase order can be used to create both the bill on the vendor side and the invoice on the customer side of things. So now we're on the customer side of things. So let's do it. Back over here, and I'm going to change then the trial balance. Let's bring this up to January 2020, January 31st. 2020. What's going to happen in terms of the accounts? Well, it's just going to be an invoice. We're just doing it in a cool new way. So the invoice, just to recap, invoice is kind of one of the most confusing forms because there's a lot of accounts affected on it. So what's going to happen? The accounts receivable is going to go up by the full amount. The other side is going to be going to the income for the merchandise, only for the amount that we get to keep. The difference is going to be going to sales tax, which is the liability, a payable account that we're going to have to pay to the state later. Also, the inventory is going to be going down by the guitar, the value of the guitar that we're giving back, which is the cost, not the retail price. The other side going to cost of goods sold, which is an expense, increasing the expense, decreasing net income. Let's check it out. Let's go to the trial balance then. Back to the dashboard. We're looking for that purchase order that we can then use to make the invoice. So I'm going to go on back to the dashboard. It's going to take a little time to load up here apparently. And then we want to go down to the bills you need to pay. We're not looking at a bill. We're looking at a purchase order, but it's in the same area. So we got the bills up top, purchase orders on down below. Now we don't have anything that's in the approved section. I'm going to go to see all because I want to see like all of them. And we already said we billed it out. So we already made a bill for it. So I could go to the build section. And in the build section, we're looking for Gibson now. So we want the Gibson guitar. So I'm going to say, all right, we want the Gibson. That's the purchase order we made. We've already billed it out. We've already made a bill from this purchase order. Now we're going to go to the options up top and we're going to create or copy to an invoice this time. So we already made the bill. We already did the vendor cycle thing. Now we're going to the invoice, which is the customer cycle side of things. So there we have it, and it populates the invoice nicely for us. There it is. We have the invoice down below. It pulled over the sales price rather than the cost. Remember, the purchase order had the cost on it here. We have the sales price. It's doing the sales tax for us with the total calculation. Everything looks good. All we need to do is add the customer, which is Music Stuff Store, which is a funny name. I don't know who comes up with these things. But what's a new contact? We're going to add that new contact. I'm going to put the date up top. Let's make it the 25th. Again, maybe let's go the 26th just to make it a little different from the last one. You have to put, I'm going to put it when it's going to be due by. So I'm going to say the 26th here. Everything looks good. What's going to happen when we record this? It's always good to go over this in your mind just to practice. Well, we know it's an invoice, so the accounts receivable is going to go up. It's going to go up by the full $851.25. Then the other side is going to be going to the revenue, but it's only going to go up by the amount we get to keep, which is the cost that we charge for it, the 777.4. The difference is going to be taken by the state, which is the 73.85, which is going to go into payable because we're not paying it yet, but we're going to have to pay it at some future point. Then inventory is going to go down by some amount that's not even on here, but for the cost, it knows what it is because of the item that's set up that has the cost in it. And then the other side of that is going to be in the cost of goods sold, which is an expense account, increasing the cost of goods sold, decreasing net income. Net effect on net income is the difference between the sales, the 777.4, and the cost, which we don't see here. All right, so let's go ahead and approve it and check that out on the trial balance. So we're going to go ahead and approve that. See if it does anything funny. It's approved. That's good. We're going to go back to the trial balance, and we're going to bring that up to date. We got a date up to date. And then we're going to go into the accounts receivable and just see it should be increasing by the full amount here. So let's check and see if that is indeed the case. And we scroll down and there it is for Music Stuff Store. This is the most expensive guitar. What this Gibson, that's a good guitar, huh? So we should sell more of those. We got the 851.25 there. And then we're going to go back up top and say we're going to go back. The other side's going to be in the cost of goods. It's in the sales, which is on the income statement, but it's only for the amount that we get to keep. So we're going to go on down to the merchandise sales. We'll open up the merchandise sales and scroll on down. I think it was like 777 that we get to keep, something like that. Down here, that's what we get to keep. The difference is going to sales tax because the state's taking their sales tax, our silent partner. So we're going to go back to the state. And then there's the sales tax, so that would be in here. And then we have the inventory going down, so we sold the inventory. So let's go into the inventory account. It's going to be going down by an amount that's not even on the invoice, but the invoice is driving it, and the system knows what it is because we set up the items, so it knows what it should be going down by, which in this case is the 598. So it's going down by the 598. Back up top, then the other side of that is going to cost of goods sold, which is an expense account. So the cost of goods sold is going up for the cost, and that's going to be down here in the cost of goods sold, the other side of that 598. So let's go on down here, going up. So there is that net effect on the income statement, revenue, merchandise going up, cost of goods sold going up. The difference between the two is the net increase in net income that would appear on the income statement. Also note, of course, we would have the supporting documentation for the accounts receivable, as well as supporting document by customer who owes us the money, and the supporting documentation for inventory by the units that we have if we're tracking the inventory within the Xero system.